Hi there, this is Alvin from Dr. Wealth. Welcome to another episode, and this episode is special because I'm going to introduce to a new index or a list of stocks that may interest some of you. Right, it's going to focus on dividend stocks. So, for those who are growth investors, you can look elsewhere. This episode is mainly for the dividend investors who are looking to buy high-yielding stocks that can give out dividends in a consistent manner. Okay, so if you are that kind of investor, stay around and finish up the video. So I call this the Dr. Wealth Dividend 50. Okay, so it is an index that is based on certain rules that I developed, and I'm going to share with you how it is done, and of course the final results. What are the 50 stocks that have passed the criteria? And this index is going to focus more on Hong Kong and Singapore dividend stocks. There is a reason, or there are reasons why I prefer to look at Singapore and Hong Kong dividend stocks. First, there's no dividend taxation. In Singapore and Hong Kong, there's 0% dividend tax. This is unlike in the US, there's 30% dividend tax. Therefore, it doesn't make a lot of sense for foreign investors to buy US dividend stocks because even if the yield is high, they are going to get punished, right, by a 30% tax on that. But whereas in Hong Kong and Singapore, you don't have this dividend taxation, and therefore you get to keep more of the dividends at the end of the day. And I did bracket that generally, right? Because there are some stocks that are, or companies that are based in China, even if they are listed in Hong Kong or Singapore, they will still draw a 10% withholding tax. Okay, but that said, 10% is definitely 3 times cheaper than what the US dividend taxation is going to be. So therefore, I do think that if you are a dividend investor, it makes more sense to focus on Singapore and Hong Kong dividend stocks. And the second thing is that management are more willing to give more dividends in Singapore and Hong Kong. Why? Precisely because of the first point, there's no dividend taxation. So therefore, management are more generous in that sense, right? But in the US, the opposite happens. They do more share buybacks rather than give dividends to shareholders because the taxation would eat up a chunk of that profit distribution. So therefore, the taxation will also influence how the management decides whether to give more dividends or not. And last but not least, in Asia, there are a lot of mature and stable companies. They may not be the fastest growing company, not the most exciting companies that you see in the US, not the kind of tech stocks that you expect in Southeast Asia or Asia. And therefore, on the flip side, they offer this kind of maturity and stability. So some of these industries you are familiar with, right, like banking, REITs, as well as telecommunications. So these are rather mature industry, and they continue to give dividends to shareholders. So that is why I decided that you should focus on Hong Kong and Singapore for this dividend index. And I also want to explain the rules, right? How do I devise and why do I devise all these rules? So first of all, the dividend yield must be at least 5% or above. So why this special 5%? There's no particular reason why, but I do think that generally investors or dividend investors would feel that minimally 5% dividend yield is something that is worthwhile to pursue. Anything less than that may not be, right? Because considering that risk-free assets or even like a CPF special account give a 4%, and given the high interest environment, getting 3-4% via bonds or what is not difficult, right? But of course, if we stretch a bit longer over a longer horizon, the long-term inflation rate in Singapore is about 2+%, right? So having that 5% buffer with some buffer, I would think that that is actually enough in the long run. Okay, so therefore I cut off at about 5%, right, and more. This is something that we must also take note of. High yield doesn't mean it's good for dividend investors. For example, if a stock is giving 20% dividend yield, it may not be a good thing because the share price has plunged a lot, therefore the yield has shot up. And in this case, companies like this usually run into issues and problems which we do want to be shareholders of. So therefore, meaningful yield, I would say, is between 5 to 10% thereabouts, right? Anything too high is actually too risky. So therefore, we cannot just have dividend yield as a single criterion when we look for dividend stocks. It is definitely an important criterion, so we set at least 5%. And the second thing is that we also want the other fundamentals to be able to support the dividends, right? Because one of the key things is that you may give dividends this year, you may stop another year, you may give another year, and that's not good for investors who rely on dividends for an income, right? So therefore, we want that sustainability. It's not easy to determine that sustainability. Of course, historically, it's clear whether these companies can support the dividend policies that they employ. But going forward is anybody's guess, okay? There are some other ways, qualitative analysis, to look at the industry, to look at the competitive advantage or the moats, blah, 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 blah. But because I want to focus on a more objective way to determine these dividend stocks that is quantifiable, and therefore we cannot make this kind of judgment on the business models and such. Therefore, I also need to use a proxy, right? Something close, something numerical and close to what we can achieve with the sustainability of dividends. Therefore, that's where I came out with this earnings yield and free cash flow yield, because for a company to be able to give dividends, it must be able to make that money in the first place, right? So earnings is one, which relates to the payout ratio. So if I set earnings at least at 5%, okay, and or assuming, right, earnings yield is at 5%, dividend yield is at 5%, the payout ratio is at 1. Okay, so they can actually pay out because they did make that money in the first place. Of course, as much as possible, we want the earnings yield to be higher than the dividend yield. Therefore, they have a payout ratio of less than 1. But minimally, the earnings yield must be at 5%. Okay, so to commensurate with the dividend yield. The other thing is free cash flow, right? Why that is also important? Because earnings is on paper. Okay, it doesn't mean that the company has received the cash, and majority of time dividends are distributed in real cash. The company must also receive the cash from their customers in order to use that cash to pay out dividends to the shareholders. Therefore, free cash flow yield should also be more than 5%. Or equal or more than 5%. And for free cash flow, it's a bit trickier. In this case, I use a 5-year average because out of that three metrics, dividend yield, earnings yield, as well as free cash flow yield fluctuates the most. Some years it can be lower because of capital expenditure. Some years it can be higher because of less capital expenditure. So therefore, to smooth out, I use that 5 years average for free cash flow. So with that, we can then proxy that the dividends that the company is giving is sustainable, okay? And the third thing is, we do want to see some growth in these kind of companies, even though they are not theoretically growth stocks. We don't need them to grow at 10%, 15%, 20%, right? That's too high for them because they're in matured industry. So anything that goes with about the GDP growth rate, right? So in Singapore and Hong Kong, I think it's reasonable to expect 2-3% GDP growth rate. Consider their economy is pretty mature as well, right? Developed markets. So therefore, I set it as at least 3% and above. Okay, for all three, dividend per share, earnings per share, as well as the free cash flow compound annual growth rate in the past 5 years should have this 3% growth or above. So it's not demanding, but at least there's some growth. And why is this important? It comes from the inspiration of dividend aristocrats, right, in the US, where companies have grown their dividends for a long period of time, more than 25 years consecutively. There isn't such track record in Asia. There will be some, maybe 10 years or 15 years track record. But I do think that having some growth would help to prevent capital loss. Okay, why is that so? Because although dividend investors is going after dividends, right, at the end of the day, it's the yield that's important. But at the same time, you also do not want to see the share price going down as you hold the stock, right? So therefore, I would think that having some growth, that would give some support to the share price. In fact, the share price should appreciate over time, such that you get both capital gain as well as dividends at the end of the day. So therefore, this filter is for that reason. You want some cap gains. You want to protect the share price at a certain level. Of course, it's not foolproof. If the whole market is bad, the stocks will still get dragged down, right? But over a longer period of time, it should weather most of these crises, okay? And number 4 is the free cash flow criterion is excluded for banks. Okay, the reason is because for banks, it's very often you'll find negative free cash flow, very, very common, right? Due to their business model. Even their debt level tends to be high, right? Again, because of their business model. So why I want to include banks is because banks traditionally has also given very good consistent dividends, right? And we should not exclude them because we use a particular criteria that is detrimental or to that particular industry, banking in this case. So therefore, for free cash flow, I will not apply it to banks. Okay, and lastly, I will rank the stocks based on the market cap after the filters, and I'll select the top 50. That will form the Dr. Wealth Dividend 50. Okay, so hopefully you understand the rules behind it and why certain rules are being applied to create this index of stocks. And this is a brief overview. I know there's a lot of numbers, right? Don't worry. You can actually download the list. I will leave the link in the description box. Okay, so you can just download it and you can play around and can filter it. I just want to give some observation on the results, right? So that you can understand based on those rules, what kind of stocks are we looking at. So the good news is that the average dividend yield of that entire 50 stocks is at 7.6%. I would say it's rather high, right? Rather attractive. And you're not taking a lot of risk because this tends to be higher quality ones, and we also rank by market cap, right? Something I forgot to mention for the previous slide is that why do I have a ranking based on market cap? Is because I believe that most investors are more comfortable holding well-known names, bigger cap stocks, more well capitalized, and more liquid in that sense, and therefore I rank by market cap, right? So we avoid those penny stocks, smaller cap stocks. Okay, but that's it. There aren't enough big caps to go around within the 50. Okay, so we will still end up with some small caps along the way. So the average dividend yield is at 7.6%, and I did make a remark and say that it might be slightly lower because there are still some China companies that are in this index, and because they draw that 10% dividend tax, so the overall amount will be lower. So, but I would believe still be above 7%. Okay, so give and take a little bit on that side. So these are some of the observations I make. The first one is that it's quite bank heavy, okay, especially the top stocks, because banks in Asia are the biggest, right, market cap stocks. You have your top 4 banks in China. There are the top 3 banks in Singapore. So they are big companies, and it is not surprising that they dominate the ranking. And also because their yields are good, their dividend yields are good, and therefore they are in this dividend 50. So you can see ICBC, ABC, CCB, BOC, right, are there. And for Singapore, only DBS is not in there. I think it's because the share price went up quite a fair bit when I did this screening. Therefore, they may not make the cut for the 5% yield, right? So they are bank heavy, and there is a perennial lack of REITs, real estate investment trusts. So we know that REITs also give a lot of dividends. Dividend yields are also high, but somehow why are they left out, right? It's not deliberate. Okay, I'm just applying the rules and it just filter out this way. And the reason is because I think, right, let me explain the REIT first. Okay, so this is an example of one of the popular REITs, right? Capital Land Integrated Commercial Trust, CICT. And this is the distribution per unit trend. And you can see the trend is going downwards because of higher interest rates and also because of COVID impact. Therefore, the dividends have dropped. Okay, and this is common for almost every REIT out there, and therefore it didn't pass the criteria where the dividend must grow in the past 5 years. Okay, so it actually go the other way, and therefore it didn't make the cut into the dividend 50. But I think that in the future, when their results improve and interest rate get cut, some of these REITs DPU will start to grow again, and over the past 5 years, the new past 5 years would probably qualify some of the stocks into this dividend 50. All right, so it's just a temporary thing, in my opinion. And I just want to also share, maybe some of you have concerns that, how can some of these China banks go into this dividend 50? Aren't they having the crisis, property crisis, and aren't they having all these issues going on in China? Is it risky? The yield may not materialize at the end of the day. The thing is, if you look at this ICBC's past 6 years dividend per share, it has been on an upward trend, or at least pretty steady. Despite COVID, despite, in fact, the property crisis, it continued to pay out rather the same amount of dividends. So therefore, I think the resiliency is there, right? And if they pass the criteria, means they pass the criteria. There's no point that we second guess those criteria that's meant to fish out some of these good dividend stocks, okay? And another observation is that there are also some small caps that did deliver good returns over the past 5 years, right? Although this is a little bit forward-looking bias because we don't have the point in time data 5 years ago, right? But I would think that some of you will be interested to know the performance, right? The thing is that I didn't do a back test. Okay, to do a back test for Singapore Hong Kong stocks are usually more difficult due to the data availability. Doing back testing on US stocks is a lot easier, right? So I don't have a back test for this. I can only give you some flavor of how some of these stocks perform in the past 5 years. So the top performers were something along the lines of smaller caps. Okay, let me blow this up for you. Right, so they range from 100% to almost 500% in the past 5 years. Right, so these are actually great returns, right? Considering that they are dividend stocks, they're not supposed to give so much capital gain, but they did. Some of these smaller cap stocks did deliver their returns, and there are some names are like Kinetic Development, Plover Bay, Hafari, which is Singapore stock, CNOOC, and SAS Dragon, right? One of them, like CNOOC, right? CNOOC, I pronounce it CNOOC, okay, is a big cap, it's not a small cap, right, in this case. So there is a good mix of performance over here as well, right, in terms of capital gain. And out of the 50 stocks in the Dr. Wealth Dividend 50, 10 of them are Singapore stocks. Okay, this is natural that we will have less or fewer Singapore names within the index. It's because there are generally fewer stocks in Singapore, right? About 600, and in Hong Kong there's about 2,500. So easily Hong Kong stocks will outnumber by 5 times, which is in fact the case, right? End up we have 10, and there's 40, another 40 Hong Kong stocks within the Dividend 50. So these are the 10 Singapore stocks. We have OCBC, UOB, right? Other than that, they are the non-index components. Okay, they are non-index, they are smaller companies. But I would say that they are, if you go and backtrack their performances, they are rather good as well. Another thing that I wanted to also observe is that do these companies really have a good dividend track record in the past 5 years? Okay, going forward, of course, we don't know, right? But the rules are meant to filter out those that deliver dividend growth. So I picked some of these Singapore stocks, okay, especially the smaller ones, to give you a sense, right? So there's Hourglass, okay, the general trend is upwards. This is the dividend per share history, yeah? So you can see the general trend is upwards. Hafari is also upwards. Ban Leong is also upwards. Hua Tiong, there are few years that didn't pay out dividends, okay, but they did pay out big dividends in December 2023 or FY23. Okay, so this is not so good because the consistency is not there. But my observation is that the other stocks generally have this upward trend in their dividend per share over the past 5 years. Okay, so I would say that the criteria generally have picked up good counters for dividends per se. So last slide, right? So how can you use this dividend, Dr. Wealth Dividend 50, okay, index? First, use it as an idea generation. If you're a dividend investor, you look through the list, you study each of them, and you may have found some of the ideas that may be a good opportunity for you. The other way is to replicate the whole list, right? Don't want to think so much, you trust the rules, you think the rules are sound, because 50 stocks is diversified enough, it's about 2% weightage for each stock, and you can just buy all of them and you can rebalance every year, right? So my idea is to because I don't have back test, but I'm going to forward test this. Okay, so I form a model portfolio on this, and then every year we will refresh the list. Okay, then we see how it goes, right? And if you want the editable spreadsheet, the link is in the description. You can download it, right? Just give us an email, we'll send it to you. Okay, hope you like this video, especially dividend investor. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.